Okay. Yep. Hi, everyone. Thank you for joining me this evening. It's great to have all of you here. I'm James, market strategist at Tiger Broker Singapore. Today, I'll be discussing the Magnificent Seven. My topic is, can the Magnificent Seven save your stock portfolio in 2024? Today is a big topic, so I anticipate the session will last between 45 minutes to 1 hour. Rest assured, the webinar replay will be uploaded on both YouTube and Tiger app. You are welcome to come back later and watch it at your convenience. Once again, I would like to provide my conclusion first at the start of the webinar. Despite the fact that the Magnificent Seven stocks have gone up a lot in prices last year, I believe they are long-term winners and certainly deserve a place in your portfolio. I understand that many investors may already have some of these 7 stocks in their portfolios. However, the crucial question here is whether they have invested enough in these stocks within their portfolio. Okay. Let me go through the disclaimer first. This presentation is provided to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. Today, I'll be discussing how AI drives these 7 stocks prices higher. Almost all of them have already announced their earnings last week, except for Nvidia. So today's session is also like an earnings review session to identify any risks that could hinder their performance this year. Lastly, I will discuss how you should invest in these stocks, including the immediate support and resistance levels. Additionally, I will explore whether options or ETFs can be used apart from stocks to gain exposure to these stocks. Let's address this question first before diving into each of 7 stocks individually. Since the Magnificent 7 stocks have jumped up a lot in share prices last year, are they still worth it? The short answer is yes, definitely. One argument put forth by investors is that market trends or overall market climate constantly undergo changes. Some believe that AI might be a bubble, and if it bursts, the value of these 7 stocks may not remain as high as it is currently. This is one of the key reasons you see a frequent change in the top 10 most valuable companies in the US. Personally, I often use market cap as a metric to assess a company's success. Companies that constantly increase in value, increase in market cap over the years are considered of high quality. However, due to changes in the market climate, industry landscape, or technological advancement, it's challenging for some companies to stay as valuable as they were before. Nevertheless, one trend I observed over the past decade is that technology and software companies have demonstrated the ability to transcend time and grow bigger. This leads me to believe that as long as the Magnificent 7 stocks, typically technology and software companies, remain innovative, they have the potential for further growth. And the fact that all the Magnificent 7 stocks are among the largest 11 companies in the world by market cap support this perspective. And I anticipate that they may continue to hold their positions in the coming years. What I also learned from the table here is hardware or manufacturing companies often face challenges in sustaining high market cap over the years due to dynamic nature of the industry trends. For example, GE, ExxonMobil, Coca-Cola have all dropped from the top 10 list. Basically, there is limited potential growth for companies not engaged in technology and focus on selling physical products. In contrast, there is limitless potential for software services companies themselves. One of the reasons is service profit margin is typically higher. This is why many companies are actively expanding their services revenue. And one of the main reasons these 7 companies can still grow their revenue is because of AI. The generative AI market is expected to grow to 1.3 trillion over the next 10 years from a market size of just 40 billion in 2022, which means the generative AI sector could expand at a rate of 42% CAGR over the next 10 years. Companies like Amazon, Microsoft, Google, and Nvidia are likely to be among the biggest winners from the AI boom. You may wonder why there is a need to develop AI and for companies to invest in AI. It's because AI is typically the solution to improve how companies operate, typically important now due to shortage of workers. There are many jobs openings in the US that remain unfilled because the country does not have enough workers to fill them. The primary reason for the shortage is a structural problem, which is aging population, leading to a lower labor force participation rate at 62% that we are seeing in December itself. And to address this issue, companies can utilize AI and automation to enhance their productivity. This is why I believe the Magnificent Seven will perform well in the coming years. However, investors like you or me find it difficult to convince themselves to invest because all of these 7 stocks have already increased by a lot in share prices last year. For example, Nvidia increased by 239% last year. Facebook increased by 194%. Amazon went up by 80% last year. Nevertheless, I maintain the view that AI is a long-term secular growth trend, and the investment in AI is unlikely to stop anytime soon. It's also important to understand that these 7 stocks account for 28% of the S&P 500 weight and 39% of the Nasdaq 100 weight. So if you think that S&P 500 is going up this year, generally Magnificent 7 stocks are likely to perform well this year as well. To put it simply, you cannot pull up S&P 500 without pulling up Magnificent 7 stocks first. In terms of revenue growth, the Magnificent 7 stocks are expected to achieve a compound annual growth rate of 11% from 2023 to 2025, significantly outpacing the 3% rate for the remaining 493 companies in the S&P 500. In addition, the Magnificent Seven's net profit margin is 19%, outperforming 9.8% profit margin for the rest of the companies. So despite the common belief that these 7 stocks is typically a crowded trade, investors simply cannot avoid the Magnificent 7. In summary, the world is facing a severe labor shortage, making it prudent to invest in technology companies like the Magnificent 7 that have the cash flow to develop AI. Okay, let's talk about Meta Platforms, which happens to be my least favorite among the Magnificent 7 stocks. So I will go through all of them one by one. The primary reason for my reservation about Meta Platforms is its venture into Metaverse. So the company has spent a lot of money on Metaverse over the past 2 years, Despite these efforts, there are little evidence that Metaverse will work. Although Metaverse revenue increased by 344 million or 47% compared to the same quarter in 2022, the operating loss also grew by 367 million or 8.5% year over year. In addition, it appears that the losses will continue to expand. Mark Zuckerberg mentioned that operating losses are expected to increase meaningfully year over year due to ongoing product development. But why? No one seems to care about Metaverse. So no one is talking about Metaverse during the earnings call or after the earnings call itself. And why did Meta's stock jump 20% when the earnings result was released? There are a couple of reasons for that. Firstly, Meta delivered better than expected result. Earning per share, revenue, active user, ARPU, all exceeded expectation, or beat expectations. What I particularly like is the growth in operating income, which increased by 256% year over year. Secondly, the forecasted revenue also assisted the street's expectations. One of the reasons for the bump in earnings is layoffs. So Meta actually laid off 22% of their employees last year, cutting over 20,000 jobs. Another reason for the increase in earnings is the 23% year-over-year growth in advertising revenue. So Meta management attributes the growth in advertising revenue to generative AI, as AI assists in creating the personalized content for users like you and me. Additionally, we can observe that Meta ad pricing grew by 2% in the latest quarter, driven by both cyclical advertisement recovery and advertisement targeting. So the trend itself is expected to persist given the company's success with the new ad tool that incorporate generative AI features. So in any case, I believe that this new ad tool will improve the advertisement growth itself. So basically, it was launched last October. So these are the new generative AI elements for ad creations, including text variations, background generations, and image expansion tools last October, with a global rollout to be completed this year. Essentially, this will enhance the advertiser productivity, but for laymen like me, I basically think that the increase in advertising revenue is mainly because Facebook and Instagram have more advertisement than before. Nowadays, for every 2 or 3 posts that you see on Facebook or Instagram, you will come across at least one advertisement. The third reason why Meta gained so much on the earnings announcement is because Meta announced a dividend payout. So even though the dividend payout is just 50 cents a share, this will still attract dividend investors to invest in Meta, anticipating that the company will further increase their dividend payout in the future. Lastly, Meta also announced a 50 billion share buyback. As for Meta AI's Llama, which is Meta's version of ChatGPT, some users are saying that it is better than ChatGPT. However, I believe that investors should not be overly excited about this Llama yet. It's prudent to wait for a clearer monetization roadmap for Llama. Meta also hosts the also holds the second largest digital advertising market share by revenue. And I think that the biggest catalyst for Meta this year is the US presidential elections, which will likely drive the growth in advertising revenue in the second half this year. So if you would like to gain exposure to digital advertising revenue, you probably like Meta. The year-over-year ad revenue increased by 23%, surpassing the 10% advertising growth observed in Google. However, the advertising revenue accounts for 96% of Meta's total revenue, making the companies appear somewhat like a one-trick pony, which makes Meta quite vulnerable to economy outlook. If the economy slows down, corporate might want to reduce their advertising spending. And the biggest risk for Meta is the metaverse, which demands substantial capex. In the short term, I also believe that metaverse is going nowhere. All in all, I consider Meta an okay investment, but the valuations appear stretched at the current share price of $454. My preferred strategy is to probably wait for a better entry price. Okay, let me quickly go through the technical analysis. Meta chart looks quite toppish at the moment. Recently, the share price has hit the Fibonacci extension level of 127% at $485 and go down to $454. It's possible that we may see a sell down to $400 first to close the price gap before moving higher. But Bloomberg consensus target price is $507 at the moment, indicating a 11% upside from the current price. So I might be wrong because it still looks quite positive fundamentally. So it may not go down to $400. The next stock that I like is Alphabet. Let's go through the latest earnings result. The earnings results were not bad. Both revenue and earning per share beat market expectations. However, investors are not happy because overall advertising revenue and YouTube's advertisement missed their expectations. Alphabet did not provide any financial numbers to let us know how AI investment has benefited the search, YouTube, and cloud services. This is one of the important notes to. Okay, let's look at Alphabet AI capability. Generally, Alphabet is always late to the AI party. Microsoft launched ChatGPT first, then Google launched Bard AI. Microsoft also launched ChatGPT 4 before Google introduced Google Gemini. Google will launch Bard Advanced after the release of Microsoft Copilot Pro. So basically, Microsoft enjoys most of the first mover advantage. AI will also have a more direct impact on Alphabet's advertising business. So Google is using AI to target ads for more effectively to users, leading to a higher click rate, higher click-through rates, and advertisement revenue. This means advertisers get more exposure. Google users like you and me receive more relevant targeted advertisement, and Google generates more revenue. Let me share with you some of the key highlights of the earnings result. Firstly, if we look at the year-on-year growth, we can see that most of the products or services hit the bottom a few quarters ago and are now resuming double-digit growth. Secondly, the advertising year-on-year growth is 11%. It does not look exciting compared to Meta's 23% growth rate or Microsoft's 26% growth rate during the same quarter. However, I'm not too worried about Google's advertising revenue because Google's advertising revenue is 70% bigger than Facebook's advertising revenue. So it's quite normal to have slower growth when the base is already so big. Thirdly, Google Other is secretly growing quite fast. It grew at 22% year over year in the latest quarter. Google Other basically includes revenue from the Google Play Store, smartphone devices, and YouTube premium subscriptions. And they are all doing not bad. Fourthly, Google Cloud revenue increased by 25% year over year in the latest quarter, which is quite encouraging, especially considering that Google Cloud has been profitable in the last 4 quarters. Fifthly, operating income increased by 30% year over year in the latest quarter. Furthermore, the overall operating profit margin is 27%. What I particularly like is the Google Cloud operating margin, which now stands at 9.4%. This indicates a gradual increase in profitability for Google Cloud. It's also worth noting that Amazon AWS operating margin is 29%, suggesting significant potential upside for Google Cloud's operating margin. Lastly, investors may be concerned about traffic acquisition costs, TAC, which have reached an all-time high at 14 billion and have been increasing over the years. However, it's important to look at TAC together with the advertising revenue. If you view it that way, TAC as a percentage of the advertising revenue is quite consistent at 21%. So even though TAC is at an all-time high, it indicates that the expenses Google incurs to gain traffic are justified by the revenue generated. So you should not be worried. All in all, I like Google, but if investors are looking to gain exposure to generative AI, I believe they may prefer Microsoft over Google. Google is still considered one of the best investment choices for exposure to advertising revenue. Additionally, I think that generative AI like ChatGPT may potentially displace Google search in the future. The biggest risk lies in the potential slowdown of Google search advertising revenue. So especially considering there are so many advertising choices available nowadays, and if we look at the revenue generated from YouTube advertisement, Google Cloud, and Google Others, they are not sufficient to compensate the loss in Google search revenue at the moment, if there is a loss in Google search revenue. Okay. In terms of technical analysis, Google's share price looks a bit toppish at the moment. It's probably double top in the making. Additionally, in the near term, there may be a head and shoulders pattern emerging once it breaks below the net line at $137. However, it's important to note that these patterns have not fully formed yet. As such, traders may want to refrain themselves from reacting immediately. You could consider these supports and resistance levels as profit-taking targets or entry prices. Okay, let's now talk about Tesla. Tesla is one of my favorite growth stocks. Tesla is ranked as number 5 on this list. I probably will spend a bit more time on Tesla because I reckon it's easy to fall in love with other stocks on this list, but it's not easy for investors to like Tesla now. So it has one of the most exciting AI stories. Firstly, full self-driving capability. It's estimated that the full self-driving take rate is about 20% in the US. However, if Tesla could reach level 5 full self-driving in the future, we should see a higher take rate, also unlocking the potential for a robotaxi. The global robotaxi market size is expected to reach 46 billion by 2030 at a CAGR of 91% from 2023 to 2030. Secondly, the Dojo supercomputer is worth mentioning. The Dojo system is a Tesla-designed supercomputer used to train its artificial intelligence system that support, again, full self-driving, autonomous driving. So Morgan Stanley previously estimated that Dojo could add 500 billion to Tesla market cap. Elon Musk also mentioned that Dojo could be opened up to other companies as a service, similar to how Amazon rents out the server infrastructure as AWS. Thirdly, Tesla Optimus. It's estimated that humanoid robot market could be worth 154 billion by 2035. So while every investor is excited about generative AI, I believe that if Tesla succeeds in any one of these AI development that I mentioned earlier, the company could open up new, huge total addressable markets. Having said that, I see significant potential for Tesla future growth. However, as of now, Tesla remains an electric vehicles company. Currently, 85% of the total revenues comes from selling electric vehicles, and the company is facing some challenges at the moment. In the latest earnings report, both revenue and earnings fell below market expectations, and the company also warned of notably lower electric vehicle sales growth in 2024. If you remember, Elon Musk said in 2021 that Tesla would grow at a 50% growth rate annually for the foreseeable future. This 50% target seems unlikely now. Analysts are now forecasting a growth rate closer to 20% for the next few years. And if you dive into the financial statement, you could see that despite reaching an all-time high in revenue, the year-on-year growth in revenue has slowed down to just 3% in the latest quarter. Furthermore, the year-on-year growth in operating income is negative 47% in the latest quarter. On a full year basis, the 2023 operating income declined by 35%. And the profit margin also saw a significant decrease. The gross margin, which was 29% in first quarter 2022, has now dropped to 17% in the latest quarter. The operating margin, which was quite impressive at 19% in the first quarter 2022, has fallen to 8% in the latest quarter. All in all, Tesla's current financial performance does not look like a growth company. And the key reason for the poor earnings is probably slower car sales, and Tesla keeps cutting car prices also hurts the profit margin. Tesla has adopted a more aggressive approach to cutting car prices over the past year, especially considering that Tesla has been reducing car prices by over 25% in the last 4 years. But the cost of goods sold per vehicles has only managed to come down by 19%. As a result, investors are growing impatient, wondering how much lower the profit margin need to go. I think Elon Musk summed it up quite nicely when he stated that Tesla is currently between the two growth waves. The first wave was driven by the release of Model 3 and Model Y back in 2017 and 2020 respectively. And the second wave will start with the next generation vehicle platform. So this new next generation platform is projected to cut costs by 50% for the current Model 3 and Model Y. And this new manufacturing system will be used to produce the highly anticipated 25,000 next-gen vehicles, which is the more affordable electric vehicles. Let's briefly go through the biggest risks. Elon Musk say that he's uncomfortable growing AI and robotics at the company without earnings outlook. I maintain a long-term constructive view on Tesla. I believe the game changer will be next generation platform, which Tesla is releasing this new next gen low-cost vehicles in 2025. While there's skepticism about the earnings result this year, I anticipate that Tesla could maybe surprise all of us by exceeding the expectations. Lastly, given the rate cut outlook, I also think that there could be a PE expansion for Tesla stock itself. Okay, Tesla is currently trading at $185. There is possibility that Tesla share price could decline to $100 again. However, considering that Tesla is trading at 55% below its all-time high, it appears that Tesla share price looks attractive for long-term investors at the moment. My preferred investment strategy is to gradually accumulate at this support level, 173, 143, 106 itself. Okay, the next stock I like to share is Amazon. It's ranked number 4 on my list. Let me quickly go through the latest earning result. Revenue and earnings per share beat expectations, mainly due to holiday sales exceeding the market expectations. The forecasted sales for the next quarter is also higher than the market expectation as well. In terms of the AI outlook, CEO Andy Jassy say that the generative AI revenue is still relatively small, but AI will drive tens of billions of dollars of revenue over the next several years. Last week, Amazon launched Rufus, a new AI-powered shopping assistant aimed at transforming the online shopping experience for you and me. for customer. It will help user in navigating Amazon's extensive product catalog and making more informed purchasing decisions. Amazon also invested 4 billion on Anthropics in September last year. Basically, Anthropics is similar to OpenAI, is basically similar to Microsoft invested in OpenAI. And in November last year, Amazon also launched a workplace assistant called Amazon Q. There are rumors that Amazon Q uses Anthropic AI-based model. Basically, Amazon Q is similar to ChatGPT, but aims specifically at businesses. It can answer employees' questions, generate content, and take action using the company data. Now, let's all look at the latest earnings. There are a lot of information on this table. Let me point out some of the most important takeaway. Firstly, first-party online store grew by 8% year-over-year in the latest quarter. However, I reckon that first-party profit margin is not as good as the third-party seller services revenue. Therefore, I normally emphasize more on the third-party seller revenue, which has seen a 19% year-on-year growth in the latest quarter. The third-party sales also contributes increasingly more to the total revenue over the years, increasing from 21% in the first quarter 2022 to 25% in the latest quarter, whereas the first-party sales contributions has decreased from 43% to 41% over the same period. Secondly, Amazon advertising is a force not to be missed. Amazon digital advertising currently holds the third place in global market share at 7%, which is quite impressive. If you look at the advertising year-on-year growth in the latest quarter, Amazon basically grew by 26%, whereas Facebook only grew by 23% and Google grew by 10% itself. So if you have noticed, you are also seeing some advertisement on Prime Video as well, which I think this will drive the future advertising revenue. Thirdly, Amazon Cloud Unit AWS increased by 13% year-over-year, showing slower growth compared to Microsoft Azure's and Google Cloud. Basically, Azure Cloud growth was 30% and Google Cloud's was 25%, indicating that Amazon AWS market share has been gradually taken away by Microsoft Azure. So some argue that Microsoft is a better cloud player to gain exposure to the cloud computing industry. Maybe. However, Microsoft never truly discloses the actual revenue for Azure, leading to speculation that in terms of operating profit margin or operating income, Azure might be worse than AWS. For example, the operating profit margin for Amazon AWS is 29%, while Google Cloud is 9%. I think it's possible that Azure profit margin is lower than AWS. Alternatively, if you measure market share by operating income, not revenue, AWS market share may be substantially higher than Microsoft Azure itself. Fourthly, I also like to briefly talk about subscription service, which is Amazon Prime. If you look closely at the year-over-year revenue growth for the last 2 years, there are only 3 segments that provided double-digit revenue growth every quarter. They are advertising revenue, subscription revenue, and AWS. So Amazon Prime, which is a subscription revenue, has seen significant growth in subscribers, not only in US, but globally in the past few years. I believe they are growing strongly in the last 2 years because they have been aggressively promoted Prime subscription beyond the US. The business model for Prime membership is quite simple. They offer a low subscription fee to attract more people to sign up. And once subscribers are hooked with the Prime benefits, Amazon gradually raises the price. For example, the US Prime membership is $15 per month, whereas in Singapore, it's still charging 3 Singapore dollars per month. So I see a lot of room for to raise the Prime membership prices. Lastly, I also want to show you the yearly return versus the yearly share price return versus the free cash flow. Amazon share price usually ends the year with substantial gain if there is significant increase in the free cash flow itself. So last year, the free cash flow was at its all-time high, and Amazon returned about 77%. I think free cash flow this year could do well. So does the share price. All in all, I like Amazon. I appreciate CEO Andy Jassy leadership. Amazon has weathered the most challenging period, which was 2022, when the company experienced a significant dip in the revenue growth year over year. At this stage, I don't see Amazon as an AI company, but more of a cloud plus e-commerce plus Prime membership company. It is also the market leader in cloud and US e-commerce at the moment. So I believe that if you like to invest in market leader in cloud or in US e-commerce, Amazon is one of the best choices out there. Amazon chart looks interesting. Essentially, it has formed inverted head and shoulder with a target price of $205. Additionally, if you draw a Fibonacci extension, the 100% extension level also aligns with $205. Therefore, I see a major resistance level at 205. I anticipate traders will likely aim to push the share price higher to $205 first. However, if you see a decline in share price first, then these support levels could serve as some of the good accumulations levels for long-term investment. Now let's talk about Nvidia. I've ranked Nvidia as number 3 among the among the Magnificent Seven. And currently it holds the position as the 6th largest company in the world by market cap. However, I see the potential to become the world's largest company. I believe many of you must have heard enough of Nvidia, and his earnings date is on February 21st. Therefore, there isn't much to update about Nvidia at the moment. I believe Nvidia has benefited the most from the first wave of AI, as it stands as the picks and shovels leader in the AI gold rush. Companies that want to develop AI needs Nvidia GPU chips. While it's true that many companies like Google, Amazon, Microsoft are designing their own chips. Nvidia's GPU chips remain irreplaceable at the moment. Some investors may argue that AMD produces better AI chips. I do not have an engineering background to tell you the differences. However, I still prefer Nvidia GPUs because it's currently the market leader in AI chips, estimated to have over 70% of the market share. And once a company starts using Nvidia chips for AI training, it's quite unlikely they would switch halfway to another chip. Nvidia has also established an ecosystem around its AI chip through Nvidia CUDA software, which is a software to train AI to construct AI models, and it supports Nvidia GPUs exclusively. As a result, many developers are already using Nvidia CUDA software and Nvidia GPU hardware, which is why I believe AMD has already lost the battle in this regard. But other companies like Facebook may still turn to AMD to reduce dependence on Nvidia's AI chips. Companies will try to place order with AMD to diminish the strong pricing power that Nvidia has at the moment. However, the demand for Nvidia GPUs remain high. This is why I'm not surprised that Nvidia is the best performing stock among the Magnificent Seven at the moment. The biggest risk for Nvidia is likely associated with China. US has imposed a ban on exporting Nvidia AI chips to China. Roughly 20 to 25% of the company revenue in the data center divisions, which houses Nvidia AI chips, has come from China. However, there are rumors that Nvidia has found a workaround. The company has introduced a cut down or dumbed down version of its product that comply with the American export policies. So they may soon exporting AI chips to China again. I believe no one knows what the revenue upside limit for Nvidia is, as the company consistently surprises all of us on the upside with the earnings announcement and forecasts. I believe as long as Nvidia continues to provide earnings surprises, the share price can remain elevated, sustaining the expensive valuations. Nvidia may be priced for perfection now, but the growth portfolio managers, the growth funds likely have no choice but to keep investing in Nvidia, because if they don't, their performance will lag behind other funds that owns Nvidia. Especially Nvidia has gone up 230% last year, and the year-to-date return is about 37%. Nvidia is currently trading at $682 last night. The immediate resistance is $710, representing only a 4% upside relative to the current share price. If you consider $710 to be a strong resistance level, one investment strategy that you may adopt is to wait and only invest when the share price breaks above $710. Meanwhile, you could queue to buy Nvidia at all this support level. Okay, let's talk about Microsoft. Microsoft is my second favorite among the Magnificent Seven stocks. Okay, let me go through the earnings first. Both Microsoft's revenue and earnings per share beat market expectations. However, the forecasted revenue for the next quarter slightly missed analyst estimations. Microsoft Azure grew 30% year over year in the latest quarter. In comparison, Amazon AWS only grew by 13%. Microsoft also stated that AI-related services contributed 6 percentage points of revenue growth in Azure cloud businesses in the latest quarter. And if I'm not mistaken, Microsoft is the only company among the 7 stocks that provides the concrete number on how AI impacts its earnings, which is a good sign. Microsoft's current AI offerings include Copilot, OpenAI, Azure AI. Microsoft also is launching a GPT App Store soon. The year-on-year growth in the operating income is amazingly good. It grew by 32% in the latest quarter. The key growth driver is intelligent cloud. It has been contributing more to the operating income. Intelligent cloud previously only account for 37% of the total operating income. Now it accounts for 46%. All in all, I think other than Nvidia, Microsoft has a better AI monetization roadmap among all. I also reckon that the expensive valuations is justified given the fast revenue growth and the growth in free cash flow as well. We shall see margin expansion due to AI. Azure growth should continue to surprise all of us. The growth in Copilot should start showing up in Office, Windows revenue, maybe in the next few quarters. Here, I also like to show you some of the resistance and support levels using Fibonacci analysis. Essentially, Fibonacci analysis indicates that the most significant resistance level is at $430. Therefore, I wouldn't be surprised if Microsoft stock rises by another 6% to reach $430 first before experiencing a meaningful corrections. However, my preferred strategy is to invest partially at the current share price, $405 first, to at least capture some of the market return. If the share price decreases, investors can still accumulate at some of the support levels here. Next, I like to talk about Apple. Apple is my favorite stock among the 7 stocks. Many investors may prefer Microsoft as their top holding. While I admit that Apple's AI story may not sound so exciting compared to Microsoft's, I like Apple partly because I reckon Tim Cook is a good business executor. Additionally, Warren Buffett is also holding nearly 50% of its Berkshire Hathaway's portfolio in Apple, which also proves that Apple is one of the best value investing stocks. Apple latest earnings result was okay. If you think that Apple earnings result is not good at all, you are just being mean. Both revenue and earnings per share beat market expectations. Most importantly, iPhone revenue also beat expectations. However, Tim Cook also mentioned that iPhone sales in China were down by mid-single digits in the latest quarter. As a result, many investors are quite worried that iPhone sales in China may continue to decline in the coming years, especially this year. I think maybe considering China's uneven economic recovery and strong competition from local smartphone players like Huawei, I think that the Chinese smartphone market is likely a bit saturated now. But for me, I believe that the main battlefield is probably not China, but India. India could be an exciting market for Apple because India's GPT growth is expected to outpace China's for the next 3 years, and its middle class is booming. However, not many people, not a lot of investors are talking about iPhone sales in India yet, possibly because Apple does not disclose its revenue contribution from India. Despite not appearing on the list of the smartphone market share in terms of shipment volume, Apple holds the largest market share by revenue in India, increasing from 17% in 2022 to 23% in 2023, despite capturing just 6.5% shares by volume. So in terms of ultra premium segment, Apple has a commanding 71% market share. This is why I'm not worried about declining sales in China, because my focus is in India itself. One important thing I noticed is that service revenue this quarter is at its all-time high at 23 billion, accounting for 19% of its total revenue. So why, you may ask, why is service revenue is important? Because the gross profit margin for services is higher than the product profit margin. The service gross profit margin is 72% compared to 39% that we see in products. However, there is one major fundamental change that may disrupt Apple's service revenue, which is the EU Digital Markets Act. You may think of it as an antitrust act by the EU. So what happened here is that Apple did not allow mobile app developer to use alternative in-app payment system other than its own. Apple, which is Apple store itself, Apple Pay. So the EU say to Apple that Apple is not allowed to do that in Europe. So starting in March, Apple will allow app downloads from outside the App Store for the first time and make purchases from outside its App Store. In that case, Apple cannot take a cut from the in-app purchase. For example, if you have been paying Netflix monthly subscription fee through Apple Pay at the moment, 30% of your monthly subscription fee goes to Apple. But because of this EU law, if you download Netflix outside the App Store and pay Netflix subscription fee not using the Apple Pay on your phone, Apple will not earn the Netflix subscription fee at all. Now, under this EU law, basically in future, you can play Fortnite on iPhones without going through the App Store. And Epic Games, which own Fortnite, does not need to pay a cut of revenue to Apple. And if app developers decided to stay in the Apple App Store, Apple is lenient enough. Apple is saying that they will reduce the default revenue cut from 30% to 17% or to 10%. But to make up of this lost revenue, Apple will charge some additional fees. Basically, Apple will charge a new 3% payment processing fees for apps that use Apple in-app purchase system. Furthermore, if your app has been installed more than 1 million times each year, either through the Apple App Store or the third-party App Store, Apple will charge 0.5 euro dollar per new app install. So I think other than the slower China revenue, this EU digital market act is an additional risk to Apple. Apple basically estimates that EU only accounts for approximately 6% of Apple's total App Store sales, but I still reckon that investors should monitor this if there is a huge decline in Apple service revenue moving forward. Okay, let's briefly talk about Apple AI. Basically, Apple seldom mentions AI during the earnings call, but in the latest earnings call, Tim Cook teases about AI and generative AI. So I believe that every Apple investor should be excited about this. Maybe an AI iPhone is happening later this year, especially since its competitor Samsung has launched an AI-powered Galaxy S24 this January. All in all, I reckon that investors have mostly priced in a slower iPhone sales this year. However, I reckon investors have not priced in Apple's AI capabilities yet. Apple has a good history of launching successful products at the right moment, so I am patiently waiting for an AI moment for Apple. These are some of the support and resistance levels based on Fibonacci retracement level. I believe 177.28 would be a good support level. It seems quite challenging for Apple stock to drop to $162 because this would indicate an 18% drop from the all-time high. Basically, Apple stock does not experience a drawdown of more than 20% unless there is a major fundamental event. Okay. Lastly, let's talk about investment strategies. So just now I've shared the ranking of these 7 stocks, and now I'd like to present my preferred weight for these 7 stocks within an aggressive portfolio. I also share this portfolio in my US Outlook webinar 2 weeks ago. I basically assigned a significant 56% weight to the Magnificent 7 stocks. You may wonder why 56%, which is higher than 39% in Nasdaq 100 or 28% weight in S&P 500. The rationale behind this allocation is because I believe that these 7 stocks will likely outperform the remaining stocks in the index in the long run. If you look closely, you could also see that I assign a 13% weight to my favorite Magnificent 7 stocks, Apple. But the only Magnificent 7 stock missing here is Facebook. Again, I'm a bit biased against Facebook, which is why it is excluded from this portfolio. However, if you like Facebook, I recommend a 4% weight for Facebook in an aggressive portfolio itself. Another way to gain exposure to the Magnificent 7 stocks is by investing in ETF. The first one is Round Hill Magnificent 7 stocks. Magnificent 7's ETF. This ETF invests in the 7 stocks and is rebalanced on a quarterly basis to ensure equal weighting among them. However, the AUM is quite low at 93 million, resulting in a wide bid-ask spread. Last week, there's another new ETF called UMax Magnificent 7 Funds of Option Income ETF launch. This ETF uses a cover call strategy to generate income, but the maximum gain is limited. These 2 ETFs sound promising on paper, but I recommend investors to monitor their performance and liquidity before considering investing. Otherwise, I believe the best way to invest in these 7 stocks is still through the S&P 500 ETF or Nasdaq 100 ETF itself. Just bear in mind that these 7 companies account for 28% in S&P 500 and 39% in Nasdaq 100 weight itself. Another consideration is probably buying deep in the money, LEAPS call, which is one of my favorite option strategies. Alternatively, selling put is also a good strategy if you intend to own the underlying asset. If the share price fall below the put strike price, the put will be assigned, allowing you to buy the underlying share at a discount. And I have been talking to some investors in the past 1 month, and I reckon that they are mostly underinvested and waiting for corrections. And it seems like many of them at this moment are waiting for a lower price to accumulate. I would say that, yeah, it's good to accumulate stock at a lower price if the market correction happens, but you should also consider there is a risk of missing out if the market correction doesn't come, and you will be forced to chase the market at a higher price later. This is why I reckon investors should be at least 70% invested in the market. If you find it tough to start investing, you should probably consider dollar cost averaging. You can set up an auto invest plan through Tiger app to buy these 7 stocks at a fixed dollar amount at a fixed interval. And I also mentioned some support levels earlier based on technical analysis, which you may consider slowly accumulate at those levels. In conclusion, I reckon that these 7 stocks will provide you with some decent return this year, and I think they definitely deserve a place in your portfolio. For an aggressive pure stock portfolio, investor may consider investing 30 to 60% of the portfolio in these 7 stocks. I believe that they have a better chance in converting their AI investment into profit compared to smaller player. And it's also important to acknowledge that investing in these stocks may come with higher risk, which may have larger drawdowns because they have gone up so much due to AI optimism. Taking Nvidia as an example, there is a chance of a 50% drawdown in Nvidia before reaching $1,000. So I reckon investors need to understand their risk tolerance level and implementing careful position sizing while investing in these stocks. Okay, I believe I have run out of time. That's all for me today. Okay, let's move to Q&A. Give me a minute. I'm still opening up the room. Okay. Okay, I see the first question is it still worth to buy Meta? So again, I would like to say that I am biased on Meta. If you were to look at the chart that I showed up earlier, you could see that I kind of believe that it may drop to $400 first before going higher. So I think the risk is there. But fundamentally, I believe a lot of analysts have upgraded their target price for Meta. So if you uh, like Meta fundamentally, I think maybe at the current price, there are still some upside potential for Meta. But again, maybe it's just me. I don't quite like Mark Zuckerberg uh, management style. So this is why, again, I'm very biased. Okay. Okay, is it too late to enter Nvidia now? Okay, I believe a lot of value investors um, will scratch their head and look at the share price of Nvidia at the moment, which is standing at $682 and say that it's quite expensive now. Yes, it's always expensive. But a lot of growth investors, like I say, if you want to chase performance, you still somehow need to own some Nvidia because if you don't, other funds have been holding Nvidia will outperform you. So you have no choice but to maybe invest into Nvidia if you are a growth investor yourself. Is it too late to invest in? I would say that I really do not know because if Nvidia consistently surprises all of us in terms of the earnings result and the earnings forecast, I don't see that it's a limit now. I think the valuations is justified because once the earnings is really better than expectation, the PE ratio will come down. And so all in all, what I like to say is that you should consider careful position sizing. For example, if you decided to invest 9% of your portfolio into Nvidia, maybe you can allocate the first 3% in Nvidia at $682 first, and then you allocate another 3% at 646 and another 3% at 595. So basically, the first 3% that you invested at this price at least give you some market return, at least help you to capture some market return. Otherwise, right, if you consistently going up to hit 710, 792, or 835, I believe a lot of growth investors will be kicking themselves for missing out the trade itself. Okay, what do you think of Berkshire Hathaway? Okay, if you are a long-term investor, I would consider Berkshire Hathaway as a financial stock. So I think it's an okay investment because if you look at performance for the past 5 years, past 10 years, or the past 20 years, they have consistently outperformed S&P 500 in the long run. So I think it's a not bad investment itself. So basically, investing in Berkshire Hathaway is like putting your money for Warren Buffett to help you manage. And I basically think that, yeah, it's a good company. I see the earnings, the revenue has consistently grow over years. Okay, so one question for Tesla. Okay, by the way, if you miss out any more of the slides, you can always watch the webinar replay that we uploaded on YouTube and the channel that you are seeing now, which is the Tiger Life app. Okay, so maybe let me explain about a little bit on the technical analysis itself. So basically, I identify these are some of the resistance levels and these are some of the support levels. So basically, 106 and 107 is the conference zone if you combine two Fibonacci levels, retracement levels and extension level together, you can find that 107 and 106 are quite a strong resistance level, support level that I think Tesla share price should be bottoming here should it drop to this level based on technical analysis. But again, if you were to look at beta of Tesla versus S&P 500, I think the beta is about 0.56 times. Meaning to say, the correlation, not the beta. The correlation itself is 0.56. Meaning to say, when S&P 500 goes up or goes down, the correlation is maybe just 56%. So it's not a lot compared to the rest of the Magnificent Seven stocks. So Tesla somehow managed to move by itself based on their own news rather than follow the broad-based market return. And I should say that while there is a lot of bad news, especially a lot of investors are talking about slower China car sales, and then Tesla will consistently lower the profit margin. Yes, that is a huge worry for a lot of us. But I should say that you should also look at Elon Musk's execution skill. Somehow rather, maybe he can deliver better than expected execution on the earnings result itself. So I believe that a lot of bad news has already been priced in. So this is why I would consider $185, which is 55% lower than the all-time high, is considered one of the better entry price. Yep. Okay. Okay, one question from Larry. Can Temu surpasses Amazon? Okay, this is a good question. I shall say that it's difficult because if you were to look at how US protected their own companies in the past, you will know that when a company from overseas grew large enough, they will maybe issue some law. They will have some law to actually limit their potential growth in the future. And this is number one. Number two is that companies like Temu or Shein at the moment, right, are bypassing some law in order to have some subsidy itself. So basically, they are not paying some of the taxes because of one of the EU law or something like that. I can't remember the exact name for that. But again, right, law regulators are looking into this and probably want to ask them to pay these taxations. So again, right, can Temu consistently lower their good price itself in US? I would have some doubt. So this is why I would say that yes, Temu, which is selling China goods to US audience, will have some market share. Definitely there's a market for that. But can they have turned this investment into profit? That is a bit